Hi, welcome to ARK Invest's Big Ideas 2026 Deep Dive. I'm Brett Winton, the Chief Futurist, and I'm going to start right on slide 4, which is titled The Great Acceleration. The core thesis, both in this section and across the entire deck, is that AI is the central dynamo, the spinning wheel of magic that is accelerating, all the 5 major innovation platforms that we focus on and igniting a new era of macroeconomic growth. So the 5 major innovation platforms: AI, public blockchains, robotics, energy storage, and multiomics. Each of these are technology platforms that are following steep cost declines. They're cutting across sectors, and they're themselves platforms on top of which other innovations can be built. On the right, you can see kind of the innovations that we focus on today, the technologies that we focus on today. In AI, it's neural nets, intelligent devices, and next-gen cloud. In robotics, it's humanoid robots, reusable rockets, and specialized robots. In energy storage, it's autonomous mobility, distributed energy generation, and advanced battery technology. In public blockchains, it's cryptocurrencies, smart contracts, and digital wallets. And in multiomics, it's the multiomic technology, the core sequencers, precision therapies, and programmable biology. This visualization on the right is how these technologies interconnect and catalyze growth one to another. So just emerging over the latter half of 25 was the idea that reusable rockets would be sending chips that also power Tesla's autonomous vehicles into orbit to power the next gen cloud, which is required for neural nets to operate and scale. Similarly, multiomics data will live in users' digital wallets, which then will be used to kind of train neural nets to better understand biological data and help to catalyze the growth of precision therapies. So these technologies are increasingly interconnected and accelerating. And actually, if you look at, we go through a scoring exercise called convergent scoring to look at to what degree is one technology likely to catalyze the growth in another, and how much growth should we anticipate that it'll catalyze. And that's increased over time. So that's visualized on the bottom. Actually, year over year, there's a 35% increase in the network density. Think of this as the degree to which technologies are likely to enhance each other. And if you look at on the right side, it's at the innovation platform basis. Robotics has seen the most growth, and then neural networks and AI, as I described, is the most important technology. The fact that AI is accelerating so quickly is why the entire technology cycle is accelerating quickly, because it's feedstock into all of these innovation platforms. And so this is an example of a new example of convergence that we think is going to meaningfully increase demand for an underlying technology. So lofting satellites with computer chips on them in order to power AI training and inference, we think is going to be cost competitive, and actually even potentially better in a unit cost than going through the effort of building a data center on the ground. The way to think about this is like all of the material that goes into the data center on the ground, exclusive of the chips, instead you package it into the satellite, and you don't have to deal with negotiating for land rights and getting permitting to operate in that specific area, or finding pumping natural gas to that area and buying natural gas turbines to power that plant. Instead, it's all powered by solar, and it lives in space. So we think it'll be cost competitive. With that assumption, given the volumes of AI compute demand that are out there, relative to our prior expectations for what SpaceX was going to need to loft for its Starlink opportunity, we think there could be a 60x increase in kind of demand for their core technology for reusable rockets. So here's an example where the demand from neural networks for tokens is powering demand for next gen cloud, and SpaceX, by meeting that demand, could yield a 60x increase in kind of the demand for its underlying technology. So all of this acceleration is feeding into a radically a historic investment cycle between data centers, software, robo taxis, and then into the 2030s, humanoid robots. We think the investment in the underlying foundational assets that power technology is going to inflect and exceed any period in history, even going back to the railroad, where building out the railroads consumed a large or contributed a large portion to GDP at that time. And so when disruptive technology enters the economy, you actually get four kinds of macroeconomic acceleration from that entry. First, you accelerate capital formation. What do I mean by that? I mean the dollars go into building the underlying infrastructure you need to use the technology. So that's the data centers. That's investing in kind of the software that's going to run inside the enterprise and learn how to operate in the enterprise. That's purchasing the vehicles that become the robo taxis. And so prior to the introduction of the technology, that capital might have been kind of sitting in cash. Look at the big tech, large cap tech balance sheets. They were sitting on cash. Now they're realizing, oh, to compete, we have to build these data centers. Okay, then once you bring the capital in, if the technology really is transformative, you should actually have a superior return on capital relative to what it was doing before. And so the data centers, and we believe this to be true, will return kind of a better ROI. They'll return more cash relative to the amount invested, both to the owners and macroeconomically than you would otherwise get. So you get the foundation of economic growth, and then you get the returns on that foundation improving. Part of the way those returns improve is they take non-market activity and they transform it into market activity. You can see on the right, we're highlighting how robotaxis fits into this framework. Well, across the US, we drive so much manually driving that it's in excess of $4 trillion of unpaid imputed wages driving. That's just not recognized in GDP. So if you deliver a robotaxi, people won't pay the full freight for what they would have been paid if they were paid to drive, but they'll pay a discount to that in order to have a service drive them around. And so that'll go from imputed wages that weren't recognized into a value that gets recognized into GDP. And then finally, they have additional time while they're doing that. Since they're not paying the full wage out, people who are riding around in a robotaxi have additional time where they could work. They could work at their full wage rate. And so then that's economically productive. Or they could watch Netflix, which they'll likely do. And that's macroeconomically productive too, because when you not watch Netflix, that means you're paying for Netflix. And so you're, doing something else with your money or time. Just to make this a little more tangible, here's a specific example of how disruptive technology impacts the technology. Here we're looking at a single robot level. So on the left is what happens today. Right now, for a homeowner in the US, on average, they're paying $2,600 out to people who come in, like electricians or housekeepers, or somebody that comes in to like a handyman to fix up a cabinet. And they do a lot of work on their houses. In fact, if you look at the imputed labor cost of the work they're doing, it's $65,000 at average wages across the US in annual work that they're doing and not paid for. They're doing it just to keep up their home. So if you introduce a single humanoid robot to that household, we think because they're saving so much time in labor, people will pay a lot for that. In fact, if you amortize it over the life of, or a 5-year life of the robot, we think they'll pay $20,000 essentially per year for access to that robot. You can think they no longer need the car because they're getting driven around by robotaxis. So then they'll buy the robot. So then the robot does the work that would otherwise be done by people in the household and by the work that they're doing, and that costs $3,600 in operating costs for the robot on electricity and maintenance. Then the homeowner is willing to pay the free labor time is worth $30,000, and then there's other work that would otherwise not be done by the robot, which is or otherwise wouldn't be done by the homeowner. So think of the sock drawer that's disorganized, the vacuuming that doesn't get done. That's worth $7,000, and so you end up with a $60,000 contribution per year to the economy for a humanoid robot that gets recognized into GDP, where previously only 2,600 appeared. And there's also kind of like the labor hours, the value of the leisure hours where kind of you're able to watch Netflix instead of vacuuming, and your household is better organized. So you just feel better, and maybe you're healthier because things are more clean. You're more easily able to find that set of socks you're looking for to do well on that sales pitch you're going to do. And so kind of like there's other surpluses that aren't captured here, but the change is a more than 30-fold increase in GDP just for a single humanoid robot. So if you were to penetrate the market with go from basically 0 to 80% penetration over a business cycle over 5 years, that alone could accelerate GDP from the 2 to 3% per year to the 5% 6% per year level. And in aggregate, the influx of these technologies, consistent with history, we think is going to change the equilibrium level of GDP growth. Actually, over the latter half of this decade, we think we're going to average more than 7% real growth, up from basically 125 years of roughly 3% growth. In prior technological periods, you had structurally lower growth. What does this mean? It means everybody is going to get a lot wealthier. This is great. And it means that, and it's catalyzed, driven by the technologies that we see being introduced today across AI, public blockchains, robotics, energy storage, and multiomics. All of these contribute to this transformation and growth. And, markets will follow the macros. But before we get to that, people often ask, well, what about quantum computing? What about fusion? There are technologies that are interesting, and at some point in the future, they may be disrupted. But the work that we've done suggests, at least in the quantum computing case and in the fuel cell case and in the fusion power case, that not yet, it is not time yet. So disruptive technologies require a steep cost decline, unit economic cases across multiple sectors that prove compelling, and that allows them to commercialize and get to scale and serve as platforms for additional technological innovation. Quantum computing's cost decline has actually been modest. I mean, you've doubled qubits over 4 years for the leading player in Google. Even if you assume they accelerate to a Moore's law style case, we think the big meaningful application of quantum computing, cracking RSA encryption, won't happen until the mid 2040s, and more likely, even with an acceleration to unit doublings every 3 years, it would be in the 2050s before it happens. Now, there's a lot that's going to happen between now and 2044. So for us, it's just not interesting from an investing perspective. But there are plenty of technologies that are interesting. And as I said, the macroeconomic growth is going to, in our view, yield kind of market appreciation. And so if you look at the long history of innovation market cap versus non-innovation market cap, as shown on the left, we have had a period of inflections and growth in innovation, and we think that's going to accelerate. So from 2015 to 2020, innovation compounded at 18%, 2020 to 2025, 20%, and we think it's going to accelerate as these technologies deliver a more meaningful marginal share of economic growth over time. And by contrast, it could be that non-innovation market cap, so incumbent companies that are in all of the indices, will shrink over the next 5 years. So imagine a period where you have accelerating GDP, you have a set of companies that are accruing massive enterprise value, and if you're not successfully innovation exposed, you produce negative returns in your portfolio. What a nightmare. I think everybody needs to make sure that they are positively exposed to innovation in a meaningful way, given the point we are in the technological cycle. And you can see on the right, we think that across crypto, as well as private and public, that innovation is going to make up more than 60% of global market cap, in our view, by 2030. And while that may sound like outrageous and extreme and large, well, it matches our underlying modeling for the individual technologies and the way they're accelerating. It also matches, historical timeframes where there have been big bursts of investment and innovation. Actually, if you go back to 1870, railroads made up more than 60% share of equity market cap in the late 1800s, and it was because they prompted this huge wave of capital investment that had higher than normal returns because traveling by rail was so efficient. It allowed non-market activity, having to walk from place to place or ride horses from place to place, into something that was measured into the economy, and it freed up people's time to do more productive activity, and served as a platform on which other innovations can be built. Much of the build out of the West depended on the railroad. Well, much of the build out of the future world will depend upon the radical capability that we think AI is going to deliver to us over this 5 years and the decades to come. So that's a dive into the big ideas, great acceleration portion from ARK Invest. I hope you enjoyed it.
This is Frank Downing, Research Director at ARK, focused on AI, cloud computing, and software. And today we're going to go over our AI infrastructure section of our Big Ideas 2026 report, which you can find on the ark-invest.com website. So jumping right into what we see in the current state of the AI market is a continued explosion in demand. When we look at, for example, the tokens inferenced on OpenRouter over the last year, since December of 2024, they've grown over 25-fold. And what's really driving this is a reduction in cost and an increase in performance of the leading models, combined with models finally being built into products that we use in our everyday life, both on our time spent as a consumer using AI in our day-to-day, and AI getting rolled into the workplace, both through kind of general subscriptions like ChatGPT for Enterprise or Anthropic's Claude product, and through kind of vertical specific applications. And we talk through all of that in detail in our AI productivity section. But focusing on cost declines for a second, this is something that's really important and foundational in our research at ARK, and it helps us understand when a technology is ready for prime time and will grow to meet more and more use cases over time. We use this, for example, in studying electric vehicles in the past to know that the cost declines in electric batteries would allow electric vehicles not only to be possible, but profitable at scale. And we're seeing these same dynamics play out in the AI space. There's a lot of benchmarks out there. If you look at artificial analysis, which does an index of many of the leading benchmarks, the cost to achieve a certain level of intelligence on that benchmark has fallen by 99% over the last year. And we see this across many different benchmarks, which again, we speak to in other sections of this deck. But this kind of evokes this concept of Jevons paradox, where a decline in cost actually increases the market size and increases the demand because you're unlocking new use cases. We see that in domains like software development, for example, where as coding models have become more intelligent relative to the price you're paying, software developers are leaning in harder and harder and using and consuming more tokens than they were in prior years. And what is all that doing? It's driving a huge investment in the underlying infrastructure required to run generative AI. We've seen the long-term trend of data center system spending, which was growing at a 5% annual rate over the last 10 years prior to the launch of ChatGPT. It was growing slowly from $150 billion to about $200 billion per year. That has inflected upwards, and since the launch of ChatGPT, accelerated to grow at a 29% annual rate, hitting $500 billion, nearly $500 billion in 2025. And the current market estimates are for that to grow to nearly $600 billion in 2026. If you're wondering what data center systems are, these are the compute servers, networking to connect them, and storage that's attached to them that are put into data centers. So really the core IT equipment driving these workloads. It doesn't include, which is a whole nother big expense, the data center actual facility and power that gets connected and enabled to power all those IT systems. And I think this is where we spent a good amount of time in our research this year, which is adding historical perspective on where we are in the cycle. There's a lot of fears of being in an AI bubble in the market today, and we wanted to shed some light on that. Looking at the left side of this chart, we looked at, how big is the scale of this investment relative to other times in history. And, the last time we saw a CapEx cycle like this was the tech and telecom bubble of the late 90s and early 2000s. And those numbers I mentioned on the past slide are part of the reason why this ratio of the CapEx relative to GDP for technology companies has been growing over time and is now reaching levels that haven't been seen since that late 90s period. And actually, I think what's interesting about this is if you look since the previous times this chart bottomed, both after the dot-com bubble burst in around 2002 and then after the Great Financial Crisis in 08-09, we've actually seen a consistent rise of tech CapEx as a percentage of GDP over time. And this actually intuitively makes sense if you think of, compared to the year the iPhone was launched versus now, how much more technology is represented in our day-to-day lives and how much bigger these companies just are, large cap tech today, relative to their size a decade and a half ago. On the right side chart, I think this is helpful on the market cycle context of answering that question of where are valuations and are we in a bubble? Is the market multiple higher than it was post-COVID, for example, when the market bottomed? Yes. The S&P 500 has gone from a PE multiple of around 20 to around 30. So it's definitely higher, though off what I would consider an overly pessimistic base, judging by how the market has performed since then. And if you look at large cap technology companies specifically, we've highlighted where the current Mag 6 are as of the beginning of 2026, which is around a market multiple of 40, and comparing that to what large cap tech, the Ciscos, the Oracles, the IBMs, Microsoft is the only company that's in both of these lists, where they were through the late 90s period, they actually peaked at over 100 times earnings. So if you looked at where they hit 40, that was in about 1997. So multiples are elevated, but partially because these companies are so profitable already and are funding this build out with a larger percentage of free cash flow than companies in the 90s, and because the actual returns on AI are real. There is real revenue flowing into the cloud divisions of these businesses in particular. We see multiples healthier, and this would imply there's a long way to go before we reach the same euphoria that was seen in 1999 and 2000, for example. So in the next slide here, we look at what's evolving in the heart of AI compute. These are the chip designers that are making the hardware that makes it possible to run generative AI at scale. And of course, what we've seen since they started building data center chips between 2012 and 2014, but really since the launch of ChatGPT, NVIDIA has been the star of the show. Now, 3 years into the generative AI revolution, we're seeing the beginnings of a broadening out of the market for compute providers. And a really compelling story is AMD, who's coming to market with more competitive chips, having competed against NVIDIA in the gaming space on the consumer side, and has competed against Intel very successfully in the data center side. AMD went from almost 0% market share in 2017 to 40% today in data center CPUs. And we think there's a similar share gain story possible for AMD in the data center space with regards to GPUs. They've won customers like OpenAI and Meta, for example, and are looking to extend that list as they have new chips that come to market and are even more competitive relative to NVIDIA. On the research side, we looked at performance using a variety of semi-analysis benchmarks of AMD versus NVIDIA on small models versus large models. And what you can see here on small models, relative to the cost of the chips, AMD has already caught up and is actually more performant on a performance per dollar basis, or the amount of tokens you could generate per dollar for the same model, than NVIDIA is. On the large model side, however, you can see where NVIDIA still has this huge advantage. Their rack scale solution, Grace Blackwell, can deliver 15.5 million tokens per dollar of total cost of ownership, compared to the current stats for AMD's top of the line, which is about 2.9 million tokens. So this rack scale offering really is an advantage for NVIDIA in the market today. But what we're going to see through the rest of 2026, which is important for forecasting where we're going to go, is that AMD AMD is coming to market with their own rack scale solution called Helios that they expect to go toe-to-toe with NVIDIA's next generation Vera Rubin. So we're excited to see when these products both come out in the second half of this year to see where these performance numbers go. But what we can see from the customer orders is early indications are looking like it's going to be a compelling product. Not in the chart because the benchmark data hasn't come out for it yet, but in the table is Google's TPU, which is another important part of what's happening in the AI compute market, which is the maturing and the scaling of custom silicon projects within the hyperscalers. So all of NVIDIA's biggest customers actually have different efforts to build their own AI chip. Google's TPU, Amazon's Trainium, and Microsoft's Maya series. Microsoft has really not gotten a good shot on goal yet. Trainium from Amazon would be the next most developed, and Google, having worked on the TPU for over 10 years, is definitely the most mature in the market. They're running all of their internal Gemini workloads on TPU and trained their latest model, Gemini 3, on the TPU, and it is one of the most capable frontier models out there. So we're seeing increased investment by Google on their TPU stack, and that's benefiting companies like Broadcom that are the back-end design provider, or basically the silicon partner for Google, and really like the go-between between Google and TSMC to help them scale that product. So if we take all that into context and we look out through the rest of this decade, we are, again, at around $500 billion in annual data center system spending now. We think with the scaling of AI applications and the continued cost declines we're seeing, that total investment could nearly triple to $1.4 trillion by 2030. And again, a large part of that being spent on compute. And the composition of that compute market will change pretty significantly, where we have already the change in market share from traditional CPU-driven computing to accelerated computing powered by GPUs and these custom silicon projects or ASICs, application-specific chips developed by the hyperscalers. They're already taking a majority share of incremental compute spend. And we think within that, custom silicon could grow to a third or higher of spend as some of these projects like the TPU and Trainium continue to scale. So all this is setting up for what we think is a sustainable infrastructure build out. There's a chance that we go too crazy and the market overheats between now and then, but all of our research on how AI is being used and when you think about it is really early in the deployment cycle relative to how we integrated we think it can be into our daily lives, especially at work where enterprises have paused and then now are scrambling to try and figure out how can I best use AI. We think every business, just like they became common users of the internet, will become common users of AI, and the businesses that become power users will be the ones that lead, really become the next leadership in the market. So with that, that's a brief rundown of our AI infrastructure section of Big Ideas 2026. We're really excited about the research this year and the insight it's giving us into the market. And we're excited to keep on learning and following innovation.
Hello, everyone. I'm Nicholas Gruss. I'm Director of Research on the Consumer Internet and FinTech team here at ARC. Today, I'll be joined with Varshika, who is our amazing research associate, and we'll be walking through the AI consumer operating system section of Big Ideas. This section is going to focus on transforming search, discovery, transactions, and the economics of e-commerce itself, and how we believe we are entering into a new agentic world when it comes to AI. And so I'll take you right into the first slide here. We believe that the consumer operating system is changing. We've gone from command era to web era to mobile era, and now we're entering into the agentic era. This was really kicked off by the launch of ChatGPT back in 2022. But as we're seeing the evolution of AI, we believe we are moving from a world from query to answer to query to action. And this is the agentic era in a nutshell. We look at this system and what is happening here, and we think that there are two primary verticals within the consumer space where these companies can create massive revenue opportunities for themselves, but also disrupt the current incumbency and the way that business is conducted. And the primary two are really on e-commerce and advertising. Varshika is going to take you into e-commerce in the next few slides. But first, I just want to press upon how big of an opportunity we believe this is. And it's partly driven by how fast these agents and chatbots have been adopted. If you look at this slide and you look at the graph on the left-hand side, you can see that the AI adoption versus just the internet adoption itself, we're pacing well ahead of where we were a few years after the internet. When you look at how fast the adoption of chatbots has been, you're talking about almost 20% penetration, nearing in on 20% penetration just after 3 years, versus it took the internet itself around 7 years to reach the same level of penetration. So this is happening extremely fast. You need to keep your head on a swivel, and that's why Varshika is going to take you through the e-commerce section, and I will come back in to close it off around what we think is happening on advertising.
So 2025 was really the year that agentic commerce came into life. And if you've been here for a little bit, we've been talking about AI purchasing agents. And I think we're seeing that AI purchasing agents have really been able to sort of compress this consumer shopping journey as it goes from discovery, engagement, decision making to purchase. A majority of that journey actually occurs before a purchase even takes place. And that's where AI purchasing agents can come in with a great level of personalization, are able to help the consumer make the decision that's right for them. And as a result, these AI agents are also reducing the speed, reducing the time it takes to complete a transaction. So if you think about the pre-internet era, when you maybe had to go into a shopping mall or a department store to make a purchase, that entire transaction would take you maybe about an hour. It's been the time to complete a transaction has been steadily decreasing ever since the advent of the internet. And I think with the agentic era, transactions can occur in as little as 90 seconds. I think agentic protocols are what's going to make agentic commerce a reality. And I think the key to all of this and the key to unlocking agentic commerce really are the retailers who are going to be connecting their back-end systems to these protocols to give them the necessary context and data. So on the context front, I think you have MCP, which stands for Model Context Protocol from Anthropic, that's really giving these agents the necessary context and data that they need and standardizing. And this protocol as a whole is really standardizing what data access looks like for these agents. And then specifically to the commerce side, you have ACP, which is Agentic Commerce Protocol from OpenAI and Stripe. And then you have UCP, which is Universal Commerce Protocol from Google and Shopify. And those are really enabling the settlement and transaction for e-commerce. So these protocols are what's enabling agents to secure transactions on behalf of the consumer. And I think what we're seeing in the agentic AI era is that the commerce stack has really unified. So it's like from the retailer using these protocols through your agentic layer, and then ultimately interacting with the consumer interface, whether that's a chatbot, a voice assistant, or AI smart glasses. We're seeing a very unified stack, which has been a big improvement from the internet era, where you have retailers that have fragmented connections across marketplaces, social media platforms, CTV, etc. So overall, we think that as consumers delegate more of their commerce activity to AI, we think that AI agents should capture a larger share of digital transactions. So we think that's going to go from about 2% in 2025 all the way up to 25% in 2030. And that represents more than $8 trillion of online consumption globally in 2030.
So the other big opportunity here outside of e-commerce, we believe, is on advertising. And so if you look at the advertising landscape today, search is a huge component of that story. Search is around a $350 billion market. Google is a dominant player. You have others with specific verticals within search, like Amazon. But we really think that the way that AI can scale their advertising business is to disrupt and transfer some of these search advertisements into the AI and agentic world. And so we have a forecast we believe is showing exactly that playing out. We believe, AI search can grow from anywhere from 10% today to around 65% of global search traffic over the next 5 years. And really, what we've learned over the years is that advertisers are slow to adopt any new advertising platform. And so we've actually built in a bit of a lag as it comes to monetization. So it's not really one-to-one. Eyeballs don't necessarily equal dollars, at least not in the advertising world. And it takes time for advertisers to adjust to new services deployed. But we do think that over time, AI search and the advertising opportunity around it is going to grow. We've started to hear from companies like OpenAI that are going to deploy advertising. So this will be a great first year to test this thesis out in the wild and see how consumers respond to advertising within these chatbot ecosystems. So we're really excited about what AI search can mean for the aggregate consumer opportunity. And that takes us to our last slide, because I think the point we want to press on, everyone, is that when you look at the main monetization vehicles for AI today, right now it's solely centered around subscription. So direct monetization, at least on the consumer end. You have some consumption-based models on the enterprise side and a bit of consumption-based monetization on the consumer, but a lot of this is very much direct monetization. Now, we think, charging a consumer a subscription is going to be a continued way to monetize the opportunity. But if you play out the amount that these companies can charge, we think that there's a much larger opportunity in indirect monetization. And this comes from a take rate on commerce, as well as the advertising opportunity I just spoke about. And we're drawing from historical precedent. When you look at other large platforms at scale, think of social media companies. Yes, they have some direct monetization, but the majority of users are operating on these platforms in a free and freemium model. And so the way that you drive large scale revenue, we believe, is through these indirect monetization opportunities, such as AI search, advertising, as well as e-commerce. And so we believe that this market is going to grow from around $20 billion today to around $900 billion in 2030, led by these indirect monetization opportunities. And as you can think of AI lead generation tying very much into the advertising opportunity, because advertising and commerce go hand in hand. So we think that those two together really present at large the opportunity for consumer monetization within what we believe is now a new consumer operating system. And we think we are really headed toward this future faster than most believe. And that, we are going to have a drastically different human to computer interfacing within the next few years. I think what we're seeing just in these past few weeks alone point towards this agentic future is happening here and now. So we're very excited to have put this research out. We would love feedback. If you can comment, we'll definitely take in all of this. We want to hear from you about anything that you're seeing. But hopefully you've enjoyed this section of Big Ideas, and stay tuned for more. This space is moving faster than any other space we've ever covered. So it's exciting times, but thank you for tuning in.
Hi, my name is Joseph Soya. I'm a research analyst on the Next Generation Internet team here at ARK Invest. And today we're going to be going through the AI productivity section of Big Ideas 2026. 2025 was the year that chatbots began to mature into AI agents, with reasoning models becoming much more performant and developers building more comprehensive tools and frameworks on top of these models. At the beginning of 2025, AI agents could only reliably perform tasks that would take a human 5 to 6 minutes to complete. By the end of the year, agents could complete tasks that would take a human over 30 minutes to complete on their own. This reflects a significant increase in the value workers are getting out of AI, while the price of these subscriptions to AI services have largely stayed consistent. For example, after discounting for an 80% success rate on tasks, a study from OpenAI suggests that the average knowledge worker using ChatGPT saves about 50 minutes per day. At an average U.S. knowledge worker salary of $56 per hour, ChatGPT on average produces $47 per day of value. At a cost of $20 per month, ChatGPT effectively pays for itself after about half a day of use. As top-performing models push the frontier of what AI can do, the price for the best of the best has stayed relatively stable. However, the price for fixed performance is dropping dramatically. If you want the equivalent of frontier performance from a year ago, it's now over 90% cheaper in most cases. Models that reach a score of at least 50% on many benchmarks, including coding, science, and general instruction following, can now often be had for 1% to 10% of what you would have paid for similar models in early 2025. These declines have accompanied a significant increase in the demand for tokens inferenced, with tokens inferenced on platforms like OpenRouter growing 25-fold since December of 2024. These performance gains and cost declines are not only limited to US-based labs. Chinese firms made waves in early 2025 by accelerating some of these cost declines with models that lagged top performers from the US by about 6 months in terms of performance, but were often much cheaper to run. However, if China wishes to continue this progress in 2026 and beyond, they need a lot more compute. Much of China's internal semiconductor technology lags the cutting edge by 3 to 5 years, with many of their fabs being able to produce 7-nanometer chips at best. And they produce those chips on a considerably smaller scale than countries like Taiwan. We estimate that in 2024, the most recent year for which we have full data, TSMC, Taiwan's leading fab, was outpacing SMIC, which is China's leading fab, by about 38-fold when you adjust for the quality of compute being produced. But if China can ramp internal compute sources or increase access to foreign chips like NVIDIA's H200s, which they are pushing to do so, they can certainly remain in a competitive position in coming years. Zooming back out to the impact of the cost declines that we're observing, the increased value for money is driving a lot of spend on AI tools. OpenAI's annual revenue run rate has grown at a 250% annual rate over the past 2 years to roughly $20 billion. And Anthropic's revenue has grown 850% over the past 2 years to a $9 billion run rate. New specialized startups like Cursor, Harvey, OpenEvidence, and Sierra, founded in the past 3 years, are hitting milestones of 100 million or even a billion in ARR. We believe these trends will accelerate software spend growth to between 19% and 56%, depending on how aggressively enterprises adopt AI. At the midpoint, this would imply roughly similar levels of software spend growth seen during the pandemic, with spend scaling to $3 trillion in the case of modest investment in AI or almost $7 trillion in the event of accelerated investment. To put this amount of spend in context, the global number of knowledge workers has historically grown at roughly 6% annually from 2011 to 2023. Assuming steady continued wage growth, this trend implies that enterprise spend on knowledge worker wages could continue to scale from about $30 trillion estimated today to over $45 trillion by 2030. In the event of an accelerated adoption of AI, we think some of that large potential increase in labor spend would flow through to automation software instead, resulting in that annual $7 trillion of global spend on software. In that accelerated scenario, we still assume over 3% growth in knowledge worker employment, so it is assuming some offsetting of labor market growth in a strongly growing economy. In summary, as costs fall and performance scales, we're seeing more and more enterprises and knowledge workers automating portions of their workloads. We think that their investments in these automations are going to scale significantly as more performance gains are unlocked, eventually driving trillions of dollars of investment in not only software, but also AI platforms and infrastructure.
Hello, everyone. I'm David Puel, Research Trading Analyst and Associate Portfolio Manager for Digital Assets here at ARK Invest. And today we're going to go through the Bitcoin section of Big Ideas 2026. So our main focus for 2026 as it regards to Bitcoin was just seeing it mature as an institutional asset across not only the ETF cohort, but also digital asset treasuries, and just as an ever constant and ever important part of portfolio for most investors going forward. So we're going to go through the slides. A quick recap on price action here. We saw major developments under the Trump administration regarding Bitcoin and crypto adoption broadly. After the inaugural ceremony, we saw the establishment of Trump federal Bitcoin Strategic Reserve, which as opposed to buying is, let's say, just holding Bitcoin out of different seizures in criminal cases over time. This is very optimistic and a very neutral stance from governance perspective that signals government adoption quite well into the future. Next, we have several developments in the institutional front, where you see entities like Fidelity, Vanguard, Morgan Stanley leading the way in terms of Bitcoin adoption and developing Bitcoin products for their clients. And we also see a lot of adoption across states. So, for instance, the Wisconsin Pension Fund included Bitcoin in their portfolio. And we also saw for the first time U.S. state, Texas, adopting Bitcoin and actively buying it as part of their reserves. We go to the next line, the next slide, talking about Bitcoin adoption broadly, especially amongst institutions. We saw a continued adoption on the ETF front, and also increasingly so on the digital asset treasury, aka DAT front as well. So if you add the AUM or balance of Bitcoin between those two types of structures or entities, ETFs and DATs, today, or as of the end of 2025, they now add up about 12% of total Bitcoin supply, which is quite significant. And this is an increase from an 8.7% of total supply back at the end of 2024. So it's over 3 percentage point increase over a single year, which is quite significant. Next, we also noticed how, especially in terms of risk-adjusted returns, which are, one of the primary mechanisms where investors gauge a sense of risk versus return, or like portfolio placement at any given time. We also noticed that when you measure Bitcoin's risk-adjusted returns, in this case, just simply a Sharpe ratio over a yearly horizon and roll it over, if you average the roll, you get a sense that for the most part, Bitcoin was the winner here when you measure it against Ethereum, Solana, and other components of major indices, like let's say the CoinDesk 10. So across the board, Bitcoin seems to be very steady and reliable and leading the way for institutional adoption across, mainly in this case, a very healthy risk-adjusted return pattern. Next, we also noticed, and this can be measured through in several ways, but I think this chart gets a good point across, which is Bitcoin's volatility is obviously diminishing, and perhaps even more importantly, its drawdowns are less aggressive. This is particular to this last cycle that initiated in late 2022 or so, bull cycle. What we noticed, for instance, here is that when you measure the drawdown from all-time highs at any given time, as you see on the chart in the green line here, if you take it and average it out over different time horizons, in this case, 5 years, 3 years, 1 year, and 3 months, when you average it, you get a sense of not only the drawdown, but it also gives you a sense of frequency, duration, and depth of drawdowns over the time horizon you're measuring with. So if we factor that in, we notice that in 2025, at a point in time, every single average, the 5 year, 3 year, 1 year, 3 months, hit a much more muted drawdown compared to the past. So you can, for the most part, claim that on average, the maximum drawdown of Bitcoin was the least severe in 2025 across all of Bitcoin's history. Okay, so in this slide, we did some tinkering in terms of our market cap estimates for 2030, end of 2030 for Bitcoin. And basically, they were relatively similar to what we published back at the beginning of 2025, so basically a year ago. And although our estimates in terms of market cap have remained roughly the same, their components have shifted a little bit here. So in this slide, we pretty much emphasize the changes we're noticing here. On the one hand, we have the digital gold value accrual for Bitcoin being increased just for the fact that gold appreciated during 2025, giving us perhaps a higher total addressable market where Bitcoin can accrue some value out of into 2030. So on that front, the TAM for Bitcoin as a digital gold saw an increase of about 37%, which is relatively impactful. And on the other hand, we saw a decrease in our category for emerging market safe haven for Bitcoin, and this is because we have been noticing much wider adoption of stable coins versus Bitcoin in emerging markets. What we feel is happening there is that citizens in emerging economies are preferring the stability of the US dollar as a defensive mechanism for savings and even portfolio management versus Bitcoin for the time being, which is perfectly natural. We expect this perhaps to sustain to some extent, but also change as Bitcoin's volatility keeps decreasing over time. So in this bucket, the penetration rate is what changed, not the TAM. The penetration rate, meaning is our assumption on how, out of the total addressable market, how much Bitcoin is going to penetrate and take out of that TAM and contribute to ultimately to its market cap. So from that front, the penetration rate decreased by 80%, meaning we expect that Bitcoin, as opposed to holding hypothetical 100% of emerging market safe haven, it's going to decrease by 80% to 20% of the previous total into 2030, which is perfectly reasonable, and it aligns with some data we've noticed out of Chainalysis in Latin America, Sub-Saharan Africa, and so on. So on our last slide on the Bitcoin section, we thought it would be very, very helpful to refresh investors on how we see the market, not only in the Bitcoin monetary only cryptocurrency cohort, but also in the smart contracts industry as it's developing over time. So here what you see is basically our two main drivers or categories for digital assets. One is cryptocurrency, which are a pure play monetary based value accrual over time. This is mainly speaking of Bitcoin, as excel in its monetary policy of 21 million cap supply and so on. And on the other hand, we see the smart contract angle of things led in the industry by Ethereum, Solana, and other tokens over time. So basically what you see here is a target of about roughly 28 trillion by the end of 2030 across both cryptocurrency and smart contracts. And if we separate them a little bit here, we see a market cap total estimate for cryptocurrencies on monetary based digital assets from 2 trillion into 16 trillion by end of 2030. This is mainly going to accrue into Bitcoin, at least on a 70% dominance over competitors. And on the other hand, we also think that part of that ultimate 28 trillion target is going to come out of the market capitalization of the smart contract cohort led by Ethereum and Solana. This more or less would target about roughly a 6 trillion target by end of 2030. And it's based on a generative annualized revenue of about 192 billion at an average take rate of 0.75% during the period on average. So aggregate them together, cryptocurrency or monetary digital assets and smart contract assets, the expectation is we can see a growth of up to roughly 61% CAGR between now and the end of 2030. So that was a recap for our Bitcoin section and Big Ideas 2026. Please feel free to reach out on social media, and we look forward to your comments and feedback on our latest research.
Hi, everyone. My name is Lorenzo. I'm the Director of Research of Digital Assets at ARK Invest. And this year in Big Ideas 2026, we're going to go over tokenized assets. So this year, with the Genius Act in June of 2025, it has been really the biggest piece of legislation in crypto regulating stablecoins. And so what we have seen after this is really every institution, fintech, bank, or cross-border payment company develop a stablecoin or tokenization strategy. And what we've seen is now many announcements. JP Morgan has announced the JP Morgan deposit token, money market. We have seen companies like Klarna, Western Union launch their own stablecoins, and even big tech companies such as Stripe wanting to develop their own infrastructure and launching a layer one, a purpose built for payments. In the second slide, it's really the adoption of stablecoins reaching an all-time high in 2025, and now in December doing 3.5 trillion of volume. So to put this into perspective, this is more than 40 trillion in annual volume, more than Visa, MasterCard, and just payments in remittance payments in general. We believe that is going to continue to grow with more adoption in cross-border payments, treasury managements, and just consumer all over the world. So the tokenized assets market has been really the fastest market in crypto this year. We have seen tremendous growth from U.S. Treasuries, mainly for crypto companies and on-chain users wanting to get to the risk-free rate, and then commodities, right? Like we have just seen for the past 3-4 months the rise in gold price, and so with tokenized gold and other metals, those have been really the two markets that have grown the fastest, and so they've reached 19 billion at the end of this year, and we think that's gonna continue to accelerate over time. So this slide really is about liquidity and capital on the layer ones, and we wanted to focus on where are these assets actually sitting, right? And so if we look at the top 7-8 layer ones, Ethereum really remains the on-chain hub for tokenized assets and native assets, right? So what we see really in this slide is we counted the top 50 native tokens, and then stable coins, meme coins, RWAs, treasuries, and NFTs. So really like all the assets that sit on these ledgers. And Ethereum has more than 400 billion right now, and has more assets than all the rest of the L1s combined. So this is our model for tokenized assets. We wanted to model the growth basically of the tokenized asset market, and stripping down really the market for global equities, the sovereign debt, the bank deposits, venture capital, and private equity, for example. And with an adoption curve, we think the tokenized market could grow to 11 trillion in 2030, and most of that would be global public equities and sovereign debt. This is again really seeing the world from crypto natives and TradFi colliding and really merging together. We have seen exchanges and financial institutions not only launching products and assets on blockchains, but really starting to develop and launch their own infrastructure, right? And so in this chart, we've seen the adoption of the Coinbase Bitcoin-backed loans that are using a Morpho, which is a modular money market on Ethereum, and then Robinhood, which obviously has announced the launch of the layer 2s and has tokenized stocks on them. And so we've seen the growth of that over the last year. So jumping into the DeFi application section, this year has really been the year for applications. For many years, most of the value was going to layer 1 to the blockchain. And we've seen really a growth of application economics this year. And so what you can see here is for the first time, applications have out-earned blockchains in terms of revenue, and now earning almost 1.2 times what blockchains have earned over time. And this was mainly due to, first of all, many applications hitting product market fit. And number two, the power law, where we've seen really 2 or 3 applications that have hit escape velocity and really have earned most of the economics in the applications. So on the second slide, really what we wanted to show is the scale of DeFi and blockchain native companies. So we've compared assets on platform from Coinbase, Robinhood, which are more traditional off-chain exchanges, I would say, to DeFi protocols or crypto native companies, so such as Tether or Circle, and we see that really they're catching up very quickly. In this section, wanted to highlight also the efficiency and scale of blockchains in general and smart contract applications. They're extremely efficient in terms of human resources and scale extremely quickly. And so you can see in this slide, if we analyze the company revenue per employee, we have 3 crypto companies that are in the top 10 in the world, with Hyperliquid, Tether, and Pump.Fun, with each Hyperliquid having less than 15 employees, Tether less than 300 employees, and Pump.Fun probably less than 100 employees. The DeFi purse market has been one of the fierce battles really in crypto. Binance has been really the exchange where everything happens in terms of perpetual futures for now more than 10 years. And this year we've really seen DeFi catch up and starting to battle with Binance very significantly. And so Hyperliquid has been really the growth story this year. They've done more than 800 million in yearly revenue. And we can see that, between Hyperliquid, Lighter, and Aster, which are 3 different perpetual futures on-chain markets, they've taken a significant market share for Binance for the first time really in history. And the last slide really was on layer 1 valuations and what we have seen over time. And so what we want to show here is taking a 50x multiple on revenue for Bitcoin, Ethereum, and Solana. We can see that Bitcoin, which is no surprise, is 100%, almost 100% valued on monetary premium, so like moneyness properties and store of value properties. Ethereum over time as well has been shifting more from a fee-based valuation to a monetary-based valuation, with now, more than 90% of its more than 200 billion market cap valued as a monetary really asset. Solana right now, although it's trading lower, is still very much on a fee-based valuation and revenue-based. But we believe, as it's a winner takes most, even on the smart contract L1s, over time we could have like 3 or 4 platforms that have significant monetary premium, where most of the valuation is derived from that.
Hi, I'm Shay Wilberg, the Multiomics analyst here at ARC, and I'll be walking through our big ideas for 2026 research for Multiomics. I'll start by defining what Multiomics means, and then walk through our research on the downstream implications for data generation, diagnostics, drug development, and therapeutics. Multiomics reflects the fact that biology operates across multiple layers, and that setting those layers together provides a more complete understanding of what shapes health, disease, and lifespan. Rather than examining any single layer in isolation, multiomics is about capturing a systems-level view of biology. And while not limited to 5, there are 5 core layers that are commonly referenced. Genomics refers to the DNA sequence. You can think of this as your underlying biological blueprint. Epigenomics captures modifications that regulate gene expression without actually changing the DNA sequence itself. Transcriptomics measures RNA transcripts, reflecting which genes are actively expressed in a cell. Proteomics captures proteins, which carry out most of cellular functions. And metabolomics measures small molecules, such as sugars and fats, that reflect dynamic cellular activity. And together, these layers interact to shape phenotypes, the observable traits and outcomes of organisms like humans. There are companies working at different biological layers, some focused on a single layer, others spanning multiple layers to develop tools, diagnostics, and therapeutics. The takeaway is not the individual companies, but the breadth of activity across the biological stack. Innovation is occurring simultaneously at multiple layers, which creates the conditions for integrating biological data and interventions across those layers. Artificial intelligence, or AI, introduces a reinforcing cycle in biology. As more biological data is generated, models improve. And as models improve, they enable better therapeutics, tools, and diagnostics, which in turn generate more and richer data. In effect, a virtuous cycle. We organize this cycle around 4 interconnected areas. First, multiomic tools, which are generating richer biological data at lower cost, expanding both the scale and resolution of measurement. Second is molecular diagnostics, which integrates multiomic signals to detect disease earlier and with greater precision. Third, AI-developed drugs, which use these biological insights to design and optimize drug candidates more efficiently. And finally, cures represent the downstream consequence of improved biological understanding, treatments that target underlying disease mechanisms rather than just managing symptoms. And together, these areas reinforce one another as a multiomics AI flywheel. One of the most readily observable developments in multiomics is the rapid growth in biological data as costs decline. I'll start by showing how this trend is playing out. The first human reference genome sequence, i.e., the Human Genome Project, took about 13 years and cost approximately $2.7 billion to produce, including the infrastructure to do it all. Today, the cost to sequence a whole human genome has fallen dramatically and can be as low as around $100 per genome when done at scale. Based on continued declines in sequencing costs, our research suggests that by 2030, the cost could fall by another order of magnitude, reaching roughly $10 per genome. As test costs fall, test volumes increase. Based on our modeling, the total number of next-gen molecular diagnostic tests should more than double by the end of the decade. As test volumes grow, so does the amount of biological data generated. To put that into context, on an annual basis, molecular diagnostics are generating token volumes that meet and then exceed the scale used to train frontier large language models from companies like OpenAI, Google, and Anthropic. Looking ahead, our modeling suggests this data volume will scale by tenfold by 2030. On the note of AI, there is a clear inflection in AI-enabled diagnostics and medical devices beginning after late 2022. Since that point, the number of FDA approvals incorporating AI has increased meaningfully. Based on ARC's best fit modeling of approval trends, the share of AI-enabled diagnostics and devices is projected to rise from roughly 10% today to about 30% by 2030. Next, let's turn to how AI is changing the economics of drug discovery and development. Under the current industry standard, developing a new drug is a long, expensive, and highly uncertain process. From initial discovery through regulatory approval, it typically takes more than a decade, costs billions of dollars, and more than 4 out of every 5 drug candidates that enter clinical trials will ultimately fail. This combination of long timelines, high capital intensity, and low success rates has constrained productivity across the industry. In our research, AI represents a way to systematically address these constraints. Based on our modeling, AI-driven drug development has the potential to reduce time to market by roughly 40% and total development costs by about 4-fold. These gains can come from multiple points along the pipeline, from earlier stage design of higher quality drug candidates to improved biomarker development and more efficient patient matching during clinical trials. The value of AI-driven drug development ultimately comes down to 2 key factors: lower development costs and faster time to market. And a faster time to market means a longer period of time of patent-protected revenue. By truncating both cost and time, our modeling suggests that an AI-developed drug could generate roughly $3 billion in cumulative cash flow before a traditional drug even reaches break-even. And from ARC's perspective, one of the most exciting and consequential developments in healthcare is the emergence of functional cures. A functional cure refers to a therapy that can durably eliminate disease activity after a one-time or limited course of treatment, rather than requiring lifelong management of symptoms. These therapies represent a meaningful departure from the traditional chronic care model, with important clinical and economic implications. In ARC's research, we modeled that because functional cures deliver most of their value up front, they are priced significantly higher than traditional chronic therapies. For rare diseases, our modeling suggests that the average price of a cure could exceed $1 million per patient, roughly 15 times the lifetime prescription costs required to manage the disease. By capturing revenue up front, well before patent expiration, and by largely avoiding competitive overlap, cures front-load cash flows early in the commercial life cycle. In ARC's modeling, this dynamic can make cures up to 20 times more valuable than a typical drug. To make this concrete, ARC's research looks at a case study in hereditary angioedema, or HAE, a rare genetic condition that can cause sudden, painful, and sometimes life-threatening swelling episodes. Today, most patients rely on a combination of chronic prophylactic treatments to reduce attack frequency and on-demand treatments to manage breakthrough episodes. Over a patient's lifetime, the combined costs of having either on-demand or on-demand plus prophylactic treatment and the associated medical care that comes along with having HAE can reach roughly $10 to $20 million depending on the treatment regimen the patient takes. In ARC's modeling, a one-time gene editing therapy, currently in late-stage clinical development but not yet approved, has the potential to more effectively prevent attacks with just a single administration. And gene editing therapies are beginning to move beyond rare diseases into common conditions, including cardiovascular disease, the leading cause of death globally. A key enabler of this transition is the ability to perform gene editing in vivo, or editing directly within the body. Emerging clinical data show that a one-time gene editing therapy can durably lower harmful lipid levels, lipids being the fat and fat-like molecules, which are a major driver of atherosclerotic cardiovascular disease. Using a Monte Carlo simulation, our research estimates a value-based price of approximately $165,000 for a one-time therapy that reduces lifetime cardiovascular risk. In the U.S., roughly 17 million patients have atherosclerotic cardiovascular disease, meaning they already have plaque buildup, and uncontrolled lipid levels despite available care. Applying that value-based price of $165,000 to this population of 17 million implies a total addressable market of about $2.8 trillion. For context, Pfizer's statin Lipitor, used for cardiovascular disease, was a blockbuster success and one of the best-selling drugs of all time for years. Capturing even 1/12 of that TAM would match the cumulative sales of Lipitor over roughly 20 years. Given the high costs and low probabilities of success, returns on invested capital in traditional drug development are typically in the single digits. Under this framework, early-stage assets, particularly at the phase 1 stage or earlier, tend to have limited to no economic value, as most candidates fail before reaching commercialization. In ARC's research, combining AI-driven reductions in development time with lower failure rates materially changes that profile. When those dynamics are applied to curative therapies, the expected value of assets earlier in development increases substantially. Based on ARC's modeling, an AI-accelerated cure in its first phase of human testing could be worth more than $2 billion per drug. Finally, I'll turn to longevity. Longevity is sometimes associated with speculative therapies or cosmetic interventions, but the focus here is different. This section looks at longevity through the lens of biology, how advances in measuring and understanding the biology of aging are making it a more tractable scientific target. Over the past century, medical progress has meaningfully increased global lifespans, largely by preventing early deaths from infectious and chronic diseases. In 1950, global life expectancy was around 46 years. By 2023, it increased to roughly 73 years. Extending lifespans further increasingly depends on addressing the biological processes that elevate vulnerability with age. Aging is likely not driven by a single mechanism, nor does it occur uniformly across individuals or even time. It reflects the gradual dysregulation of multiple cellular and molecular processes that reduce resilience, increase disease risk, and erode function over time. These processes occur across biological layers, such as DNA replication, gene regulation, protein function, and metabolism, across trillions of cells. While many repair mechanisms exist, errors still can accumulate over time, influenced by both biology and environment. Importantly, our ability to measure biological aging has improved significantly. Earlier approaches relied on basic physiological and clinical markers such as blood pressure or bone mineral density. More recent measures in the 90s and early 2000s incorporated functional performance, including gait speed and grip strength. Over the past decade or so, molecular clocks, first based on DNA methylation and more recently on proteomic and digital signals, have increased the precision with which aging can be quantified. As our understanding and measurement of the aging biology improve, aging becomes a more tractable target for scientific study, clinical evaluation, and medical intervention. So what is the potential value of addressing the biology of aging? In ARC's research, we estimate that the U.S. longevity opportunity could be worth 1.2 quadrillion. That figure comes from a standard health economics framework based on quality-adjusted life years, or QALYs, which measures both the length and quality of life. In our modeling, if disease-related mortality and age-related functional decline were eliminated out to a theoretical max lifespan of 120, while the risk of accidental deaths remained, the U.S. population could gain approximately 11.9 billion additional QALY, or quality-adjusted life years, effectively doubling the nation's healthy life potential. Valuing each healthy life year at 100,000, a commonly used willingness to pay threshold in health economics, this translates that gain into 1.2 quadrillion total addressable market. Importantly, this is not a forecast of a single therapy or breakthrough. It is a framework for understanding value, similar to estimating the economic potential of electricity or computing before the technologies to fully harness them existed. Realizing this opportunity would likely be a compounding process, dependent on progress across multiple converging innovation platforms, such as Multiomics, artificial intelligence, and robotics, and the enabling technologies within them. With that, I'll close out the Multiomics section of Big Ideas 2026 and encourage you to check it out for more detail. Thank you.
Hey everyone, we're going to dive into the Reusable Rockets section of this year's Big Ideas. I'm Sam Corris, a director at ARC Invest, and joined by Daniel, who's an analyst on our team and has done great work for this section. All right, so we believe, and our research indicates, that space is going to be a huge economy. A lot of growth is happening here. But when we look at what is going on right now, it's less of a space story and more of a SpaceX story. And so you can see that reusable rockets have really sparked this, and SpaceX has just absolutely dominated the number of satellites in orbit as well as the upmass in orbit. And so right now, SpaceX, via its Starlink constellation, has more than 9,000 active satellites, which is, 66% of all active satellites orbiting Earth. And so, of course, there are other companies that are actively trying to do this. But SpaceX being the first one to really commercialize orbital reusable rockets has this massive head start in putting mass into orbit. And this gets to this next slide here, which is how important reusable rockets are and how they're driving launch costs decline. And really, when we look at the space economy, the key input here is launch costs. It's like if you get launch costs low enough, all of these things that people are talking about start to become economic. And so we're already seeing that with Starlink and bandwidth in space. But the next thing that's a really exciting opportunity that people are talking about is orbital data centers. And this all opens up as launch costs come down. And so you can see this is driven by a Wright's law curve. And SpaceX has brought costs down roughly 95% from over $15,000 per kilogram to under $1,000 per kilogram. But they're not done there. As we progress towards Starship and rapidly reusable rockets, this could come down another order of magnitude, closer to that $100 per kilogram point, where all of this really starts to open up.
Hey, Daniel Maguire here, research analyst on ARC's Autonomous Tech and Robotics team. So, as Sam mentioned, declining launch costs is just one component of the reusable rocket equation, and we believe the entire stack is changing. So what we've seen so far is that the near-term opportunity for cash flow generation is coming from satellite connectivity. And this is largely thanks to Wright's law, which states for every cumulative doubling in gigabits per second to orbit, the cost per gigabit per second is declining by roughly 44%. And that's one of the reasons why we have seen exponential growth in satellite connectivity. Take, for example, Starlink, which has amassed over 9 million active subscribers. But we're at the very early stages of this. For example, looking at the chart here on the right, at the start of the millennium, people were paying the same amount today for marginal capability in only a small portion of the United States, roughly 1% according to our estimate. When you fast forward today, you get amazing capabilities in the majority of the United States. But we believe there is still a way to go, and satellite connectivity is the bridge to that gap. According to our research, for a marginal cost, satellite connectivity will bring us to a future where you can be connected anywhere on the globe 24/7 should you wish. All right, so for market sizing, when you combine the likes of direct-to-cell connectivity and internet connectivity from satellite, we believe the overall satellite connectivity market could represent a $160 billion annual revenue opportunity at scale, or roughly 15% of our 2035 global communications forecast. For context, that's up from less than 1% today. So this really is a big idea and an exciting opportunity for those companies pursuing satellite connectivity. So in summary, for reusable rockets, from our perspective, full reusability is key. Really, we live in an exciting time to be able to watch this all unfold, and at times it feels like a sci-fi movie, but we're really looking forward to watching it all unfold in 2026.
My name is Akash. I am the research associate here at ARC Invest covering the robotics and autonomous technologies.
And today we're going to dive into the robotics big idea section. So let's kick it off. And really, automation, broadly speaking, is leveraging human labor. If we had no automation, we'd likely still all be working on farms and just spending all day getting enough energy to survive. So this is something that we should want a lot. But the reality is, anytime you mention robotics or automation, the normal discourse goes to, but what about jobs? And really, historically, technology frees workers from low productivity and less interesting tasks. And so, generally speaking, I would say the burden of proof on technological unemployment lies with those saying it will occur, because it has not occurred through any innovation in the past here. But obviously things can change. And so let's look at some of the data here, which is that, for the 50 years until 2000, automation and productivity coexisted with a strong and expanding labor market. And then in 2000, there was a divergence, but we think that that's largely because of structural factors, including aging demographics and globalization, not technological unemployment. And you can see this because labor productivity continues to grow, labor force participation still above where it was from the 40s through the 70s. But I think an interesting thing to look at here is that, from the 50s all the way through today, the number of labor hours worked per person per year has been coming down. And so this trend, we believe, should continue. And that's fine because you're going to be more productive with each hour you work. But at some point in the future, could this reach zero? That's really where a lot of the debate comes about. I don't think it will necessarily hit zero anytime in the near future. But even on the way from, working 4 days a week, 3 days a week, 2 days a week to, amazing abundance, there's a lot of productivity that will occur. And I think an important thing here is really to understand where we are in the history of, robotics and industrial automation, broadly speaking. And that is, really inning one of all of this. And so up until, really the past year or two, everything has been structured in terms of automation and industrial automation. And here you can see, one of the most automated companies in the world is Amazon. And they have a robot density, which is, the number of robots per 10,000 employees of 6,400, up significantly from a decade ago. But then you look at the most automated industry, which is automotive, and those are far below where Amazon is, though having increased significantly over the past 10 years. And then you look at something like manufacturing, and that's even less than the sub industry of, automotive specifically. And so we've had, decades and decades of automation. It's still improving, but you can see that relative to the best company in the world, we're really nowhere. And so there's a lot of open space for innovation. And a lot of this only opens up through unstructured robotics, which is why, generalizable robotics, humanoid robotics are so exciting. And it's an incredible opportunity. Broadly speaking, we think this is a $26 trillion opportunity, split roughly equally between manufacturing and household robotics. We can get into that breakdown. But really, if you get a humanoid robot that can perfectly one-to-one replace a human, then you fundamentally change what the economy is. And so, even though $26 trillion is a huge opportunity, if you reach that level of capability, you fundamentally change everything. And so what's the manufacturing opportunity? Well, you've got roughly 32 trillion in global manufacturing GDP as our forecast. We think that, conservatively, a humanoid robot could add 100% productivity uplift. And as a take rate, you could take like 35% of that productivity uplift. And that gets to roughly $13 trillion in opportunity. On the household side, you have a 2.8 billion person workforce, 2.3 hours of unpaid work per day, a global average salary of $12 an hour, and people valuing their free time at half of their paid wage. And that gets to a $13 trillion on the household side. Then, just going back to this chart on the left here, it really another demonstration of how early we are in this unstructured robotics side of things. And so on the left there, industrial robots, those are, the robot arms that you're probably thinking of when you think of industrial robots. There's only been 7 million of those sold since the 1960s. Again, so you see that there is a cap on how structured an environment can constrain how useful these things are, despite all of the amazing things we've done so far. But then you look at the quadrupeds and the humanoids that are far more recent, and tens of thousands. So again, just reiterating how early we are right now, but not to say that things aren't moving extremely quickly. Now I'm going to pass it over to Akash to talk about, how hard is it to get to unstructured capability?
As Sam mentioned, the tremendous opportunity there is for generalizable robots, I'm going to dive a little bit deeper into how complex it is to realize that opportunity and what that pathway actually looks like. Our research suggests that humanoids are around 200,000 times more complex than a robotaxi. The best way to think about this is that a robotaxi has basically a singular goal, taking you from point A to point B. And all of the actions that it principally takes are translated into its wheels, which moves in 4 directions, side to side and front and back. Whereas for a humanoid robot, it has multiple goals that it has to complete, such as the best way to think about it is like unloading a dishwasher. It has to take the mugs and then put it back into a cabinet, but then it has to move towards the cabinet and then put it over there. So it doesn't just act on its foot or wheels, but it has multiple joints such as its hips, arms, and legs and fingers. All of these actually compounds as it effectively acts together to create a seamless motion. But one thing does work in favor of humanoids. It's error tolerance. Given it's not a 2-ton hunk of metal that is moving at 60 miles per hour in a freeway, a little stubble as it moves around the counter wouldn't be as catastrophic as a robotaxi moving at 60 miles per hour. Now, hearing all this, one might think that if it's 200,000 times more complicated than robotaxi, and robotaxis are just getting to a point where they're commercializing at this point in time, we are probably decades away until humanoids actually become a reality. But here at ARC, when we are using the Wright's law curve to see the rate of improvement in AI hardware as well as its software, we see a clear pathway in achieving this Herculean task of complexity ratio that's more than 200,000 times. Looking at Tesla's training compute capacity and its FSD's performance gains, we can see a clear linear pathway that we could chart, and using that, we think humanoids will get to a point where it will be commercializable, just like how robotaxis are today, by 2028. And as you know, there's always these company creation and consolidation phases in the industry. We have seen it before with EVs, and in our opinion, we are seeing it right now with humanoids. We think there will be a consolidation phase following the creation phase that we are currently in, given how difficult of a task this is to create a humanoid robot. But whoever survives this and wins in this space is going to be a massive, massive winner, as we think it's going to open up a $26 trillion revenue opportunity annually in terms of the market, and potentially changing the economy as a whole. And that is why we are so excited about humanoid robotics.
Hey everyone, we're going to dive into the distributed energy section of Big Ideas, and a shout out to Akash on our team who also helped with the research. And so really starting off, it's important what makes an economy grow and what's the necessary input. If you track it all the way back, it comes to energy. And so as we have very exciting growth projections for global GDP, US GDP, all of the talk about AI and how much energy and power that requires, it does come back to this element of where are you going to get the energy from? And I think it's really important we look at this chart on the left, which is that, energy is powering this economic growth, and even throughout all of this, increasing efficiency has taken place. And so you can see from the early 90s through today, through 2022 is the most recent data point, the top economies have become increasingly energy efficient. And this is interesting, right? That goes through the internet boom. And there were huge concerns at that time around its energy intensity. And yet this trend has continued. We think that will continue to play out as people are concerned about AI and the energy demands that it requires as well. And if we look at this chart on the right, you can see that really the world for about 10 years was in slow growth mode when it comes to global power capacity additions. But this spark of AI and this, potential return on invested capital on these data centers has jump-started a new wave of investment in energy. And a lot of people look at this and they said that's a bad thing, whereas the research suggests this is in fact an incredibly good thing. For economic growth, we need to invest in energy, and the more we invest in energy, the less that energy will cost, because it really is a simple supply-demand type equation where you need to accelerate supply such that prices go down, as opposed to where we are today, which is limited supply and increasing demand, which would make prices go up.
So as Sam mentioned, energy is foundational to all economies. And what's really driving that is Wright's Law, which is foundational to ARC's research. Wright's Law states for every cumulative doubling of power or energy, costs will decline by a constant percentage. And according to our research, this has held throughout history for solar, for batteries, and even for nuclear, before being derailed in the 1970s by regulatory hurdles. But when you fast forward today and look at the nuclear environment, there are so many tailwinds facing the industry, be it executive orders to build up the nuclear fuel cycle, or the Department of Energy accelerating the deployment of advanced reactor timelines. From our perspective, all of these tailwinds are positioning nuclear to return to its previous cost trajectory. So the output from low-cost power generation comes electricity prices, and Economics 101 states when supply exceeds demand, prices will fall. And again, according to Wright's Law, throughout history, with the exception of World War II, electricity prices have declined constantly up until 1970s, where regulatory hurdles derailed nuclear construction costs, as I previously mentioned. And our research suggests that had this derailment not occurred, electricity prices would have been roughly 40% cheaper than where they are today. And that's not to say we can't get there. What's required to continue this trend is to bring on new power generation. And at the margin, as you bring on low-cost power generation and it scales to meet the power-hungry AI data centers, retail electricity prices should resume the cost decline, marking a win for residential customers as well as AI hyperscalers. So the message here is really clear. More energy is better. So then comes market sizing, and where does this net out? Well, if ARC's GDP forecast is correct, according to our chief futurist Brett Winton, of roughly 7% annualized out to 2030, we believe power capex will roughly scale to roughly $10 trillion over the next 5 years. For context, that's roughly double what cost has been spent on power capex over the last 5 years. And in order to support this power capex, we believe stationary energy storage will scale roughly 19x over the same period, continuing the trend we've seen over the last 5 years. So in summary, for distributed energy, we would say more energy is good. There is a period of stagnation for building energy, but now we're on the cusp of accelerating power capex. And we think that translates to a multi-trillion-dollar opportunity by the end of the decade. We're excited to monitor the developments for the coming year on distributed energy.
I'm Tasha Keeney, and I direct investment analysis for ARC and research for the autonomous technology and robotics team. And today I'm going to be talking about autonomous vehicles. So robotaxis are available to the public today in select cities in the US, in China, and in the Middle East. We used to be asked, will this technology be possible? Now that's very clear. There are cars roaming around without anyone in the front seat or the passenger seat that are able to pick up passengers fully autonomously. What's interesting and what's developed in the past year is that we're seeing that within its operation zone, Waymo is actually competing with Uber and Lyft, and more specifically Lyft here, as you can see, in terms of market share. So even though they have a relatively small fleet, it's clear that they're offering a service that is competitive with today's human-driven ride-hail options. But I mentioned the fleet is small. To really proliferate, we think that data advantages are still key. There are two graphs here, which my colleague Daniel McGuire made. So daily robotaxi miles. This is looking at what's actually commercial in terms of robotaxi service. So you can see here Waymo in the US and Baidu through its Apollo Go program in China are leading with commercial driverless miles. But when you zoom out to look at total data captured, which is the graph all the way on the right, this is cumulative autonomous miles. You can see here that Tesla globally really surpasses any other competitor. This is because they collect video off of their customer vehicles. All of the cars are equipped with sensor sets that are capable of sensor sets and an onboard compute system that's capable of turning the car into a fully autonomous car through software updates. So because of that, Tesla has this immense data advantage that really no one else has. It's driven both by the fact that they've been doing this for a while, having cars roll off the assembly line with this capability, plus the fact that they have a large customer fleet driving this. So they have millions of cars versus thousands at competitors. So we think that data advantage is really key to scaling this service and to advancing the technology in the future. And why are we talking about robotaxis at all? Well, the most important piece of research to remember here, and we've been saying this for years, is that autonomous vehicles will be cheaper than human-driven vehicles. And what do I mean by that? Well, if you look at the graph on the right here, you can see the average price of human-driven ride hail in Western markets is a little less than $3 now with inflation. And then the cost of driving a personal car is a little less than $1. A robotaxi could price profitably to the consumer at just 25 cents. That is at scale. So of course there are many price points in between that $2.80, actually even higher than $2.80 at more of a premium price segment, say. But in between the $2.80 and 25 cents, there's actually a lot of support for higher price points. Really, we think that autonomous driving is compelling because it will lower the cost of transportation. It'll be cheaper than you driving your personal car, and it'll be much cheaper than ride hail. But at scale, it could be as cheap as 25 cents. And in the early days, what's really critical here is, I mentioned scale previously. Well, scale in Tesla's case, in terms of manufacturing scale, also matters quite a bit. You can see that here in the graph on the left. So if you're comparing Waymo and Tesla, Waymo purchases vehicles from automotive partners. They then add on, they integrate with partners a sensor set onto that vehicle. So if you look at the price of the car plus the sensor set, which of course adds to like the incremental depreciation cost for the car because it is a more expensive car than what's rolling off the Tesla assembly line. We actually think that today, with the cars that are driving on the road, the previous generation of Waymo and the Model Ys, which Tesla has started to use in its robotaxi fleet. Tesla already has a 35% cost advantage, but at scale, we think this could be up to a 50% incremental cost advantage per mile. This matters a lot in the early commercialization days when utilization on the fleet is low. The underlying cost of the car matters significantly then. At scale, we expect the utilization rate on the car, so how often the car is actually driving around and making revenue, to really be what drives down that cost per mile. But this goes to show that being a vertically integrated automaker really matters. And autonomous ride hail could dominate urban transit. So there's a great blog that my colleague Daniel put out earlier this year, where he looked at, these are top ride hail cities, and you can see here the peaks and troughs of when people need transportation during the day. The point that we're making in Big Ideas is, okay, if you look at all of urban miles today, ride hail is actually just a very small percentage of those miles still. It's around 1%. Even though in some cities that might be up to 10, as a whole in the US, it's around 1%. And autonomous taxis, fewer autonomous taxis could replace many vehicles on the road today. So actually, just to supplant what's currently happening in human-driven ride hail, you'd only need 140,000 robotaxis because they will have higher utilization rates than the ride hail vehicles that are on the road today. To put that in perspective, that's like maybe a month of production for Tesla. You can see here on the graph that Tesla actually, with its current vehicle lineup, and of course, if you look at the top line, the Cybercab expected capacity, they already could satisfy ride hail demand in many of the top ride hail cities in the US today. And for the US as a whole, 24 million robotaxis, which is actually less than 10% of the registered vehicle fleet in the US, could supplant actually all of urban miles, again, thanks to that higher utilization rate. And robotaxis could generate around $34 trillion of enterprise value in 2030. We've said this in the past, I'll repeat it again here, that we think that the majority of the economics will accrue to the autonomous technology providers, the platform providers. These are the companies that have built the technology stack that allows the car to drive itself, because that is what lowers the cost per mile here and what will, we think, ultimately drive demand. The biggest risk to this forecast, I will point out, is that outside of Tesla, many of the traditional automakers and automaker partners to the technology players like Waymo have not made very large-scale promises in terms of the fleet of robotaxis that they plan to have on the road in the next 5 years. So we're taking a bit of a leap of faith here. We have many players in China, for instance, where things can happen at lightning speed, really overnight in terms of manufacturing scale, looking to build out robotaxi platforms. So we do expect more competitors to emerge, but I'm noting that that's actually the biggest risk to the forecast today. And then lastly, we lay out here the different parts of the ecosystem that, on the previous slide, we outlined some of the value that it will accrue to each of those pieces. Again, the piece of the puzzle that you want to be in to get the majority of the economics is the autonomous technology platform piece. We also think that fully electric automakers have a space here. Roughly a little less than 10% of the revenue, around 1% of the enterprise value. That's really just because, again, the enterprise value that we see on the platform side is so much larger. And then fleet operators or lead generators. These are companies like the ride hail partners that some of the technology providers have chosen. Also the companies that will maintain the vehicles. These may not be the companies that we know today, by the way. It could be startups that emerge in the space. But this is another important part of the puzzle that you need to launch a robotaxi service. Of course, some players might fall into all three buckets. You can see us delineating that on the slide here. But again, the bucket that will accrue the most value is the technology platform. Today, I'm going to talk about autonomous logistics. So fully autonomous deliveries here. Actually, globally, we have roughly 4 million deliveries happening by drone and rolling robot on an annualized basis already.
And when you combine this with autonomous trucks starting to pull the safety driver out, the space is really starting to take off. You have drone providers like Zipline, who've completed more than 2 million cumulative autonomous deliveries, starting their operations in Rwanda and really starting to scale US operations recently. Then look at robots. You have Starship Technologies, who have had a lot of success on college campuses, or Meituan, who's really accelerating the rollout of integrated road robots. And then finally, when you have trucks, specifically in the United States, you have Aurora Innovation, Kodiak AI, and Gatic AI, all operating driverless operations today. And the reason why we track deliveries and miles traveled is with each additional delivery completed and each mile traveled, you're accelerating the safety validation of your system and notably improving the operating efficiency of the system, which translates to lower costs to the end consumer, as Tasha will detail now.
And big picture here, why are we talking about autonomous logistics? Well, we think that compared to today's human-in-the-loop delivery systems, that costs will come down dramatically thanks to autonomous technology. So for trucks, the cost per 10 mile of a human-driven diesel truck is around 7 cents today. That could fall to just 3 cents with autonomous electric trucks. And for last mile delivery, if you use today's food delivery apps like DoorDash, for instance, in Western markets, the price to get your delivery is actually roughly equivalent with the cost of the meal itself. So you're pretty much paying double to get something delivered. It's pretty incredible that players like DoorDash have been able to command such pricing power, but that should collapse pretty dramatically with drones and robots. So that could fall to less than $1 for the delivery fee. So really what it'll look like is it will be looped in with the price of what you're buying. So you may not see the delivery fee explicitly. Overall, your order cost will just come down. And we think that this is really what could change consumer shopping habits. And you could see, a lot more goods flow over e-commerce and app-based delivery because of this. And you could see consumer buying patterns change and become a lot more frequent as the cost of delivery dramatically collapses. All in all, we think that autonomous delivery revenue could reach $480 billion in 2030. Again, we think this could reshape consumer shopping habits. And this at the last mile will be driven by drones and robots, but really autonomous vehicles of all forms, likely smaller form factors for the last mile. And for the long haul and the middle mile, this will be autonomous electric trucks. I will say that similar to robotaxis, regulation is a factor here, especially with aerial vehicles. Regulations tend to be tighter for safety reasons. And also in this space, one thing that is unique that we're seeing is that for drones and rolling robots, for instance, and trucks as well, but I would say more of an impact on the last mile solution. We're seeing a lot of the automated solutions today actually have fairly labor intensive upfront costs. So, someone who has to load the drone itself or, put the package in the rolling robot. These are pieces of the puzzle that we would expect to be fully automated in the future. But the pace of that automation could potentially have an impact on the pace of the rollout of the autonomous technology itself. But big picture, we think that autonomous delivery will make receiving goods less expensive for everyone. Thank you, everyone. I hope you enjoyed Big Ideas 2026. Thanks for watching. Please leave your thoughts and comments below on the research. We'd love to talk to you and hear from you.